Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory aspect for Chapter 10, which is about corporations, paid-in capital, and retained earnings. And this video in particular will deal with dividends. So let me get my pen here. Okay, dividends. All right, first of all, let's think about what a dividend is. All right, people invest in a business. All right. And we're going to talk about corporations here, obviously, because that's the title of the chapter. So in the corporation, they can buy preferred stock and common stock, which you should already be familiar with this if you read the chapter or if you watched the videos. So they're able to buy preferred or common stock. All businesses, all corporations will have common stock. Not all corporations will have preferred stock. It's up to the corporation to decide if they will want to have preferred stock, and the terms of the preferred stock can be very different than just buying common stock, which is buying straight stock. And you saw that in the last video that in discussing preferred and common stock. But here's the thing: people invest for two reasons, right? One is they invest for appreciation. And appreciation means the value going up. So with the stock, if the stock's price is at 100, they're looking for the price of the stock to go up to 110, and they'll capture that $10 of appreciation by buying the stock at 100 and then selling at 110. And that's what they're hoping to do, and so that they can get a return on their investment. The other way they get it is exactly that, as a return on investment, and in this case here, you can think of it as cash flow, right? Meaning I invest, X number of dollars, and I expect a return on my investment aside from appreciation. And in this case here, that cash flow for stocks is dividends, meaning I'm going to buy, say 1,000 shares of stock, and I'm hoping that the company will pay a dividend. And when they pay that, if they pay that dividend, depending upon the number of shares of stock I have, I'm going to get a portion of that dividend as a return on my investment. Okay. Now, corporations pay attention to dividends. All right. They are aware of the appreciation of the price of the stock. Okay. But if a stock is, trading at, 100 to 110, right? People, and they're gonna, what sense does it make for me to put my money into an investment that's not going to give me a return? All right, I'm going to take my money out of that stock, and I'm going to go buy another stock that's either appreciating or getting, paying out a dividend. So companies will pay dividends in order to keep the investors invested in the business. Okay. So that's what a dividend is. All right. Now, the way the dividend works is the company, they have, from their income statement, they have revenues less their expenses, which gives them a profit or loss. And that profit or loss gets closed out to retained earnings. Okay. And so the money sits in retained earnings. Now, if the company has had a good year, obviously they want to take that profit or loss and invest it back in the business. But if they have excess, they want to keep the people invested in the business, so they'll decide to pay a dividend, and that money comes out of retained earnings. Okay. Now, when they're thinking about this, I mean, it doesn't, before I go any further, it doesn't necessarily mean that the company has to have a profit for them to pay out a dividend. Some companies pay dividends regardless of profit or loss. They know they're going to be profitable over a long period of time, and they pay that dividend regularly. Okay, that's why like big blue chip, quote unquote, blue chip companies pay dividends regularly, and people invest in those blue chip companies. That's where they park their cash to be able to get a return on their investment in the form of a dividend. There's two types of dividends. There's a cash dividend and a stock dividend. Okay. I will discuss stock dividends in the next video. Okay. I'm not going to discuss stock dividends here. So we're really just talking about a cash dividend, meaning the dividend is going to be paid out in cash. So people invest in the blue chip stocks, they invest their money, and I mean, and think about it, today where interest rates are almost negative, it makes no sense to park your money in a bank. So people park their money in the stock market because the stock is paying a dividend and they get a little bit higher return on their investment because of that dividend. Right? So that's the whole idea about dividends. Now, when it comes to dividends, there is a declaration date, a date of record, and then there's a payment date. And people get these somewhat confused because the declaration date is the day that the company declares that they're going to pay the dividend. And when they declare it, they're locked into it. They have to pay it out. So if the company declares that they're going to pay a $100,000 dividend, they're locked into paying that $100,000 dividend. All right. The date of record is the date. Date of record is the date that anyone who is a shareholder, all right, on that date will get a share of that $100,000. Okay, and then of course the payment date is when it's actually paid out. Okay, so with the dividend, there's no set amount or percentage or whatever have you that the company pays out. They decide, how much it's going to be, or as a percentage or whatever have you. They look at their retained earnings, they look at the profit or loss, and they make the decision as to the amount that will be the dividend. And again, they'll declare it, which means that's the day that they're locked into it. They can't change their mind. The date of record is anyone who's a shareholder as of that date gets a share of that dividend, and of course, you see the payment date. People get those three things confused, but just keep that in mind as in the order presented. Now, I'm going to talk about dividing the dividend between common and preferred, and this idea of cumulative and non-cumulative. All right, preferred has first position, meaning they get paid before common gets paid. If there is no preferred, okay, let's say there's no preferred, then and I'm just going to make stuff up here as I go along. I'm not using the numbers in the book. Okay, if the company decided to pay a $100,000 dividend, okay, well then that $100,000 would go to all the shareholders of common stock. And let's say there's 100,000 shareholders. There's 100,000, not shareholders. There's 100,000 shares of common stock out there. Well, if there's $100,000 and there's 100,000 shares that are outstanding of common stock, then that means each share would get $1. So if you owned 100 shares, you would get a dividend of $100, right? 1 times your 100, right? If you had 2,000 shares, you'd get $2,000, right? It's basically just that simple, right? Of course, if the amount of the share, if the amount of the dividend was 200,000, okay, and there's 100,000 shares, then each share would be worth $2. So if you had 100 shares, right, 2 times 100 would mean you would get a dividend of $200. Now that's generally put into your account, And just be aware that um, you have control over whether you get that in actual cash, right, as a check in the mail, or it's reinvested. Oftentimes, the way it's set up is that if you get that $200, and let's say the price of the stock happens to be $10, right? When you get that $200, you can either get it as a check or it can be reinvested to purchase more stock. Well, if the price of the shares is $10 a share, you would get an additional 20 shares. So if you had $100, right? I mean, 100 shares, and the dividend, all right, is $2 a share, means you get $200, okay? And then because the price of the shares is $10, right, that means you would get an additional 20 shares. And so then the 20 shares plus your 100 that you originally started with means now you would have 120 shares. Okay, that is what most people do, is they allow that cash dividend to purchase more shares. Now, that's if we just have only common stock. Okay, but I had said preferred takes precedence over common generally. So what ends up happening is, um, let's say for the preferred shareholders, they are guaranteed 65% of the dividend. And now remember, this can change. It all depends upon um, the way the business decides, the corporation decides to set this up. I'm just picking numbers out of the air, but this is not far-fetched. I could have just as easily said 45%. Okay, it just all depends upon how the corporation decides to treat their shareholders. So let's just use a simple example and say the corporation says, okay, we're going to pay the preferred shareholders 65%, and the remaining 35% goes to common stock. Okay, so when there's $100,000 of dividends, okay, 65% of it goes to, and that's 65,000, 65% of it goes to the preferred shareholders right up front, okay? And then the remaining 35,000 goes to the common stock, right? Because preferred has first position, right? Now, that's, that's 65,000, okay? That goes to preferred, and we treat it the same way as we did in thinking about the common here. If I have 100 shares, okay, and let's say that the number of preferred shares outstanding is, say, let me try to figure out an easy number here. To 20, let's say there's 130,000 shares of preferred stock sitting out there. Okay, well, if there's 130,000 shares of preferred stock and there's $65,000 of dividends, right? That means each share is going to be worth, I believe it's 50 cents. Right? Let me do the math. 65 divided by 130 is 50 cents, right? So each share is worth 50 cents. Okay, and if you have 100 shares times the 50 cents per share, all right, you're going to get $50. Okay, and of course, you can either get that as cash back, or you can get that back as you can purchase more stock with that. And if, of course, if the stock is at $10 a share, right? If it's at $10 a share, that means you're going to get 5 additional shares, and so now you have 105 shares of stock, okay, a preferred stock. And you do the same exact thing for common, okay? the number of shares for common can be different than the number of shares of preferred. I mean, if there's let's say 70,000, only 70,000 shares of common, okay, well, even though there's 130 of preferred and there's only 70 of common, you do the math again, the same way for the common as you did for the preferred. So the math stays the same kind of all the time, but you have to pay attention to the different variables, okay, that are being applied. Now, let's say that let's see, I'm trying to think of examples where, let's say the agreement as far as preferred is concerned, that preferred will get the first $100,000 of dividends, and then anything remaining left over will go to common. Okay. Now notice I just changed the parameters. In the last example, I said 65%, right? And that means it was 35% here. But now I'm changing the parameters and saying, oh, well, instead of a percentage, I'm saying it's a dollar amount, $100,000, right? The first $100,000 will go to preferred, and anything remaining will go over to common. So if the corporation decides to pay a dividend of, let's say, 70,000, right? Then that full $70,000 would go to preferred, okay? And common would then get zero when those dividends are paid. And again, you calculate, the dividend per share. If there's 140,000 shares, then that's 50 cents a share, right? 140 divided into the 70,000, so that's 50 cents a share. And you're going to multiply that times however many shares you have to know what dividend amount you're going to get. That's the same math all the time, right? But the point being here is that if there's only $70,000 being paid out as the dividend that's being declared, and I should use that word, declared, so you get accustomed to it. If $70,000 is declared, because preferred gets the first 100,000, that means common gets zero, right? They don't get anything on that for that declaration. But let's say the declaration is $120,000, right? Well, then out of this 120,000, right, the first 100,000 goes to preferred, okay? And then that means there's $20,000 left over, so the $20,000 would go to common, right? Okay. So that's looking at these from a one-off perspective, meaning each and every time it comes time for a dividend to be declared, and it doesn't have to be done on a yearly basis. It could be done on a quarterly basis. It could be done semi-annually. Generally, it's done on a quarterly basis at the shortest time frame, but it can be done monthly if they wanted to. But most corporations don't do that. They do it either on a quarterly basis, semi-annual basis, or yearly basis. So those are like the general, the most common time frames: quarterly, semi-annually, or yearly, annually, same thing, right? Those are the three most common time frames for payment of dividends, right? Like I said, the blue chip stocks generally pay them on a quarterly basis. Today they have more of a tendency to pay them on an annual basis. Most smaller corporations generally pay them on an annual basis, a yearly basis. But we're talking about these as a one-off kind of thing, meaning, let's just say it's quarterly. Now let's just use yearly, right? Every year, the company looks and says, okay, we'll pay out a dividend. Well, what I just explained, applies, is what you would do for that payment at one time. I mean, for that particular dividend declaration. But there's this idea of cumulative and non-cumulative. And what that means is cumulative means it's adding one upon the other. Okay, meaning if, let's say, and it's easier to give an example of this. Now I'm going to explain cumulative. Non-cumulative means there's no adding, meaning it, in the no adding, right? So non-cumulative, meaning what happens during that year is, during that dividend declaration is all that happens. Nothing gets kind of quote unquote carried over. Okay, nothing gets carried over. Cumulative, the terms do get carried over. Okay, and let me just give you an example, and it's just easier to do it that way. So um, let's say in this first dividend period, preferred is guaranteed the first $100,000. Okay, then anything left over goes over to common, right? That's the terms of that preferred gets for having the stock. They get the first $100,000 in dividends. Anything left over goes over to common. So in this first period, let's say the corporation decides to declare a dividend of $70,000. Okay, that means they declare a $70,000 dividend, right? That means that, and this here is a cumulative, we're talking about cumulative, that means there's $30,000 left over that has not been paid to preferred, right? So what does this mean? Well, if it's only 70,000 and preferred gets 100,000, well, out of the 70,000, common gets zero, okay, because all of it went to preferred. However, preferred is still owed an additional $30,000 from this first period because it's cumulative. All right. Now, in the next dividend period, preferred stock gets an additional 100,000. All right, but they're also still owed this 30,000. So now preferred is owed $130,000. All right. Now, let's say the dividend declared is $100,000. Okay. Well, that means that common gets zero out of the 100,000. Why? Because the first 130,000 goes to preferred and anything left over goes to common. So now at the end of the second period, preferred is still owed $30,000. Okay. Now, let's say in period 3, now remember, I'm just bringing this up here, $30,000, preferred is still owed the $30,000. Okay, so for the third period, preferred gets an additional $100,000. So now they're still owed $130,000, right? And let's say the company decides to pay a $150,000 dividend. Okay, well, because this is cumulative, all right, the 130,000 is owed to preferred, but with the dividend being paid 150,000, out of the 150,000, it pays off the $30,000 that's owed to preferred. Okay, and that means there's $20,000 left over, which now goes over to common. All right, and that $20,000 is distributed to the common stock shareholders. Okay, so the way to think about cumulative is it's a carryover, all right, kind of thing. Okay, anything that's still owed is still carried over. Okay, and once that's satisfied, then anything else, anything that's left over will go to common. Now I've done this on a period by period basis, but let me go over another real quick quick example about this. All right. I realize that this video is getting kind of long. It's already at 25 minutes, but it's kind of important. All right. So let's say in this first period, again, preferred gets the first $100,000, right? So in this first period, $100,000 is what is owed to preferred, and let's say $70,000 is the dividend declared. Okay, so the 70,000 is going to go against the 100,000, all right, to preferred, and nothing goes to common. So there's $30,000 that's still owed to preferred. Now in the second period, again, preferred is owed an additional 100,000, right? So they're going to get $130,000 worth, all right? But now let's say zero is actually declared, right? So at the end of the second period, a full 130,000 is still owed to preferred. Now at the end of the third period, right, $100,000 more is owed to preferred, right? So now 230,000 is owed to preferred. Okay, and let's say 150,000 is of a dividend is declared. Okay, well that 150,000, right, all goes against the 230,000 that's owed to preferred, and there's still a remaining $80,000 that's still owed to preferred. Out of the 150, nothing goes to the common. In that last example, you know, if you had written it down, you saw that out of that 150,000, 20,000 had gone to common because that dividend had paid what was still owed to preferred. But what I want you to see here is, you get this idea of preferred is owed the money, and whatever the dividend declared needs to satisfy the preferred first. Okay, but it can happen in a variety of ways. It all depends upon the circumstances. There is no set formula for this. You can't look in the book or look at the homework exercises and follow them step by step, because each situation is entirely different. It's good to work through the exercises and problems to get accustomed to working through these different situations, but you have to think about the entire concept. You can't follow step by step blindly as to how to work a cumulative or non-cumulative problem. Okay, and that's the point I'm trying to get at here, is it all depends upon the terms. All right, now and I'm talking about this in dollar terms. What if it was done in percentages, meaning out of the dividend, say 65% is owed. Okay, well, let me just do that real quick to give an idea as to what I mean by, you have to understand the overall concept, but the way it's applied is different. Let's say preferred is not guaranteed 100,000. Let's say they get 65%. Okay, so in the first period, right? Let's just say, notice I'm making this stuff up. This is the way this works. Let's say $100,000 is, let me do this like this to keep things, $100,000 has been declared. Okay, so preferred will get 65% of it, all right, or 65,000, right? And that means so they get 65,000 out of the 100,000. So that means 35,000 goes over here to common, and nothing is still owed to preferred. Now let's say in the second period, nothing is declared. Okay, well, because it's 65%, 65% of nothing is still nothing, so nothing is owed to preferred. Okay, no dividend is declared, so no money is owed to preferred. Now we come into the third period, and let's say in the third period, $70,000 has been declared. $70,000 has been declared. Well, Preferred is going to get 65% of that, right? So 65% of 70,000 is $45,500. That's how much out of the 70,000 that is going to go to the preferred shareholders. And out of the 70,000 less 45,500, that gives us $24,500 is going to go to the common shareholders. Okay, so you see, with cumulative works better when we're talking about dollar amounts, but when it comes to a percentage, cumulative doesn't matter. I mean, sure, that preferred shareholders get first share, but as you see, by having 65% of nothing is still nothing. It doesn't matter whether it's cumulative or non-cumulative, right? So I want you to just be aware that of this idea behind cumulative and non-cumulative. Non-cumulative meaning that nothing is carried over, okay? Preferred gets satisfied first, and then anything left over goes to common. If it's cumulative, if there's still money that's owed to preferred, then in the next period, it has, it gets satisfied. Otherwise, it's, whatever is still owed is carried over, all right? And one adds upon the other, all right? Until preferred gets completely satisfied, and then the remainder, right, gets, distributed to the common shareholder. So whatever the dividend that's declared, that is all going to be paid out, but it's, you have to determine who's going to get what. How is it divided between the preferred and the common shareholder? And that's all, don't do that to me. Sorry about that. Well, I can talk through the rest of this. I don't have to worry about erasing it, and I'm not going to redo this video. So, okay, sorry for the technical glitch there, but you get the point. Any dividend, that's declared gets distributed, divided between the preferred and the common, and it all depends upon the terms that are given as far as preferred is concerned. And it's not something that's written in stone. There's no one set way of doing it. Each and every situation is different, and you have to look at each and every situation, as it is, and think through the concepts. So with that said, it's going to be important that you do the homework problems in order to get used to dealing with a variety of situations. You're going to take the concepts that you've learned, the theory, and apply it to that particular situation. You're not going to be able to go back and do things step by step. Sure, in doing the exercises, it will, in having a variety of circumstances, will get you accustomed to doing, dealing with the different variables. But there's no one set way of doing it. There's a process, there's the thought, there's the procedure of going through it, but you have to apply it to the situation. So pause the video and stop the video, watch it again, read what's in the textbook, but most importantly, do the homework problems. And if you're still not getting something when you're doing the homework problems, or you don't understand something, then definitely telephone and speak with an instructor. All right? We'll see you in the next video.